Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Thursday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So guys, for today we're going to take a look at the overall portfolio value, how it's been performing by the metrics. Of course, the buying power, what I plan on doing with that. Then we're going to take a look at our individual holdings and how they are performing from realty income all the way down to T. Rowe Price. Then our watch list with Berkshire Class B shares and what my plan is for buying that in the near future. So jumping right in, we're sitting at $56,907.22 with a $200 gain as of today. So of course, guys, the overall portfolio is going to fluctuate because the market is open, but I'm still excited. Sorry, sore throat today. But I am excited that we are sitting at 56K, nearing 57, which is awesome. Dividends will help us get there. But for today, we're up $211 with a 0.4% return. Then that 1 week mark, we are up $2,028.64 with a 3.7% rate of return. Then that 1 month mark, we are up $3,400 with a near 6.5% return. 3 month mark, we are up near $7,000 with a near 14% rate of return. Then that year to date mark, we are up $7,000 with a 14% return year to date. Then that 1 year mark, we are up $8,300 with a 17.23% return for the past year. Then all time, since I believe it's April 9th of 2018, we're up $21,575.70, a 61% return all time. So guys, over time, you can see we've been through a lot, right? I invested through COVID, through different elections. I'm 5 years in, right? So a lot of stuff has happened, and as long as you own companies that grow their revenue year over year and do good capital allocation, have solid management teams, this is what happens. Now, that does not mean you're never going to see a downturn, because look at this. The COVID slammed everybody, right? The COVID was right around there, and it slammed everybody. You're going to have downturns in the market, and the beautiful thing about doing dividend growth investing is that even if a company like AbbVie's at 150 plus right now, if the market just takes a shit and drops 15% or whatever overnight, and nothing changes with your individual companies, the revenue stay about the same. Apple's still selling iPhones, T. Rowe Price is still investing, etc. Realty Income's still collecting rent for most of their tenant base. You can take advantage of those downturns and buy quality at a discount. And that's really what my long-term strategy is. Love dividend growth investing, but my favorite scenario is buying something like Apple at 150, buying Realty Income at $50 a share, buying Altria around $30. There's always, and then keep in mind, the interesting thing about dividend investing is there's always somebody that's going to tell you it's the wrong time to buy. Those people, most of the time, are outside of the market or don't invest at all. And everybody's got an opinion about it, but not very many people take action. So that's where I differentiate myself, is instead of saying, I want to buy Realty Income at 60, I own shares, right? Same thing with Apple. And even Google and companies that I've sold, I felt like Google was a little bit overvalued and I wouldn't be able to purchase it for a while. So I put that money into Apple. So it's easy to take advice from somebody and anybody because everybody's got an opinion. But when you're investing, it's important to have your own thesis on companies and really trust your gut when it comes to holding them long term. Buying power right now is right around $230. I've got another share of Apple sitting in my buying power right now, but I don't want to purchase yet. I do want to add more to Visa and cost on average if I can. So I'm going to wait a little bit. But it is nice to see that I do have a share of Apple sitting there. Jumping in for Realty Income today, we've got $58.28 for our cost. 170 shares, $9,900 worth of market value, getting close to $10K there in that stock. $65 per share is our average cost. Around 17.5% of the portfolio is in realty income. Today, we're up $112. Total, we're down about $11.50 with a 10.37% loss. So, guys, there's been a lot of news about realty income. Not only that, there's been a lot of other financial YouTubers, Ryan Diggler Show, the Dividend dude. There's been a lot of people talking and saying that realty income is a bad investment. Honestly, guys, as long as the dividend doesn't get cut and there's no drastic change in their tenant base, I don't mind holding for the mid to long term. It does its job. You know, I've talked a lot about in past videos how Altria's main job is not to grow, it's to grow and appreciate. It's for the dividend growth. So to buy me Apple or Visa. Same thing here. The main goal for me with holding the stock is just the steady Eddie income. Every single month I get paid on the 15th, boom, 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 boom. It's clockwork. I never have to worry about it. One of the big advantages and reasons that I own realty income is I want real estate exposure. Like, I want to be able to say I own properties, but I don't have enough cash in my bank account to be going out and buying a property, right? Like, I can't go buy my neighbor's house. So this is a good way for me to own real estate that continuously gives me that monthly cash flow. A lot of other REITs do this, but they don't do it as well as realty income. And a lot of other REITs sport a really high dividend yield, and they're screwing investors too. That's another thing, is there's a lot of yield traps in the REIT sector. So realty income is one of the only ones that has a really consistent growth rate and consistency when it comes to growing their dividend as well. There are a few other ones. FRT, I believe, is a dividend king. And then ESS, Essex Property Trust, is also a dividend aristocrat. But outside of that, I don't think there are a lot of REITs that have the consistency that realty income does. And I'm okay to have a little bit lower of a growth rate, but the consistency of cash flow. Like, this is one of those that I believe, like, because the properties that they own aren't going to go anywhere, right? Like, the physical buildings and land that they're on, you can't produce more land, right? So it's one of the things that's a limited supply. So even if some of their tenants go away, like I've heard Walgreens is a lot of the, from what I've watched, Walgreens is a lot of the gripe people have with this company, and it's like 4% of their tenant base. So, I mean, yeah, it's not a great look, but because they're closing like 1,100 stores or something like that, it's a pretty decent amount of stores at Walgreens closing. But chances are most of those, I mean, they could all be owned by realty income. I'm not sure. I haven't looked yet. But even if they are, it's 4% of their tenant base. You know, they can get more leases. If they're closing those stores, it will affect the monthly, ins and outs of the company. But is it going to be a huge issue? I don't think so. 4% is not that big of a deal, especially when they just did that Spirit Realty acquisition. I know they had a lot of the same properties, but they did diversify them a bit, and they gave them more. So even if one tenant has a little bit of a pullback, I'm sure I know that they have rent increases on every single tenant for every year, so I'm not worried about that steady cash flow. So just for me personally, guys, I don't have a problem with realty income. I like them. I think they're going to be here for a long time. Real estate isn't going anywhere. Yeah, the growth rate might not be the greatest, but you don't really own this for high growth. If you want that, you buy Google, you buy Amazon, Tesla, etc. You buy a more growth-oriented company, and this isn't it. I'm okay with this growing, maybe 2 to 5% a year, and giving me that steady cash flow. Then Altria is at $49.72, 320 shares. $15,900 of market value, $47.27 for an average cost. Right around 30% of the portfolio is in Altria. Today we're up $107. Total we're up $785.31 with a 5.2% total return. So guys, Altria plays its part well. It gives me $313 every single quarter. That's enough to buy a share of Apple or Visa. That's all it needs to do for me, right? If the dividend grows, a little bit, great. I can buy a little bit more or have a little bit of spare cash after those purchases, but it does its job well. It's the offensive line that protects my quarterback. The big three in the portfolio are going to be Apple, Visa, and Coca-Cola. So it does its job. And the only way I'd sell out is if something drastically happened with the business, or the dividend got cut. Then we got Coca-Cola at $65.58. 15 shares, getting close to a grand worth of market value, which is awesome to see. Average cost is $60.54. 1.75% of the portfolio is in Coca-Cola. That will be going up. Today, we are up $5.85. Total, we're up $75.75, so made $75 there with an 8.34% return. So guys, it's just a little bit out of my buying range here, but it'll pull back eventually, and I'll be able to take advantage and buy some more shares. Then we got Apple down relatively big, 2%. Not a huge drop, but a nice drop here in Apple at $224.20. 5 shares, $1,100 worth of market value. Average cost is $209.30. Around 2% of the portfolio is in Apple. Today we're down $23. Total, we're still up $74 with a 7% return. I'd still buy it here, guys. Real small position. I want to build this up to be the single biggest position in the portfolio. I should have owned this a long time. I did own this a long time ago, in like 2018, but I should have just kept buying it. I got hesitant during the stock split, and I sold it right before the stock split, and I should have just not and kept it. So, learned from my mistakes. My long-term goal here is to have this be like relative to an Altria or an AbbVie. I wouldn't mind this being about a fourth of the portfolio, if not more. If it gains, then I'd be okay with it being more than that. But this will be the single biggest position eventually. I'm just going to keep allocating as much capital as I can to Apple. Then we got AbbVie at $175.94. 95 shares, $16,714 of market value. Average cost is $95.19. Around 30% or a third of my money is in AbbVie. Today we're up $66. Total, we're up $7,600 with a near 85% return. Dividends coming in on August 15th, so about the same time as Realty Income next month, of $147.25. Guys, the reason that this dividend is crazy is it started off as 107 and now it's at 155. So it's been growing pretty steady. They have had issues with patents and stuff like that with new drugs, and I'm not super worried about it. I think that they've dealt with losing the patent for Humira very well. They bounced back with Skyrizi and other offerings that they've had. Skyrizi is the big one, though. So overall, I think the profitability of the company is fine. I'm not worried about holding it. The only reason I would change, again, like I said with other companies, is if there was a huge dividend drop and something like Starbucks or Costco became able to give me the same amount of cash flow for this $16K. So it would take a pretty big drop for that to happen, but I'd switch out, honestly, if say if it dropped to like 75 cents or something, if they cut the dividend in half at this price currently, it'd be cheaper and more efficient to go into something like Starbucks. So as an investor, it's always important to have a plan B. And just because I've looked into Costco and Starbucks doesn't mean I dislike AbbVie. It is one of my favorite companies. That's why I own it. But you always have to have companies that you're familiar with in case something goes wrong. You know, in case something changes, in case there's a drastic change in the economic characteristics of a business, you have to have a plan B and a plan C. So for me, if something happened with AbbVie and the cash flows dropped, the dividend had a massive cut, and I didn't think that there'd be a way to get back to where they were at, so like $1.55 or whatever it is, if they ever cut it, I just find something else that I like something like Starbucks, buy it at a decent price and let it run up and get paid while I wait. Next, we got Visa at $270, $269.86, but around $270. One share, around $269.86 for market value, of course, around $270 because I only own one share. Average cost is $268.29. 48%, or sorry, excuse me, 0.48% of the portfolio is in Visa. See, Robinhood's doing it again where they don't change the ticker up at the top. Today we're down about $3. Total we're up $1.57 with a 0.5% return. So being that it is $2.86, yeah, I'd purchase it here if I had the cash. But that's what Altria and Realty Income are for. Love being able to reinvest dividends. But guys, Visa is going to be one of the big three. And just like I said with Apple, I'd happily purchase more, even if it does hit a new 52-week high. If it goes above my average cost, fine by me. I just want more of this compounding machine. They have crazy good margins. I understand the business really well. I use it every day. You have no problem swiping my card, so I should have no problem owning the stock. So overall, guys, just a great quality business, good management team, great historical growth rate as well. I think they grow at 15 to 20% with the dividend, and they do have the cash flow and growth rate to be able to sustain that. So that's really what I'm looking for. And looking at Visa for is they can kind of counteract that slower growth rate of Altria or Realty Income, and they have a great track record of growing the dividend. So even though they haven't grown it for a very long time, I believe it's like 15 years, 16 years, that growth rate is worth, the lack of consistency simply because they hadn't been paying it their whole, they don't have as long of a growth rate. But I love the business, and I understand the economics of it. People are still going to use their credit cards regardless of politics. Even near the damn COVID-19 pandemic, people were still spending their money. It was less, mind you, but people use their cards every day. It's kind of the same competitive advantage as you see in Apple. People are attached to their phones. People are attached to it. They always use their phones. It's like a sense of comfort for them. So being able to access your money in your pocket, that's something you can't duplicate. And most cards that are issued are Visa. Myself, I have 3 Visa cards. I have 2 credit cards and a debit card that are all Visa. So, and that's one of the things that when people ask me when they start investing is, how do I start picking stocks? Like, where do I start? One of my main pillars is look at what you use, look at what you own, look at what you buy. First thing I tell them is, do you drink Pepsi or Coke, or do you drink Mountain Dew? So are you directly buying from those companies every day? And most of them say one or the other. So, okay, well, there's one stock you could look into. And then do you drink Starbucks coffee? Like, have you gone to Costco in the past year? Do you have a Costco membership? What pharmaceutical company makes your antidepressant drug? Whatever you take every day. And then I ask, look in your wallet and see what company you swipe with every day. And most of the time it's Visa. If it's MasterCard, whatever, it doesn't matter. And then oh, okay, so I interact with a lot more than I think. And that's usually how I tell people to start, is just look at what you swipe. Look at the things that you buy. Look at the products that you purchase every time you go to the grocery store. Do you use gas? Do you fill up gas every week? And Visa is one of those that's just instant. Yeah, I use it. You're right. I should probably own that. So for me, this is just going to be one of those big pillars. It's one of the companies that I interact with the absolute most in my day-to-day life, and it will easily be 10 to 15% of the portfolio. Then we got T. Rowe Price sitting at $117.71. 100 shares, $11,700 of market value. Average cost is $109.73. 20% of the portfolio is in T. Rowe Price. Today, we're down $44. Total, we're up nearly $800 with a 7% return. Guys, I don't know what's going on with the top of the screen, but it is T. Rowe. It's not AbbVie. I guess even Robinhood has a favorite in my portfolio. But guys, overall, I love T. Rowe Price. It's seen a lot of pullback in the past couple of years. I'm not worried about that. I could see 50% gains here from my average cost. So it'd be up 100% from where I was at in 2021, and I just get paid $127 to wait. So I have 100% upside. I get paid, I think it's $124. So I get paid $124 to wait for it to have 100% return and double my money. And if it does, like I said, just like with AbbVie, if a stock gets relatively overvalued and I don't have a big position in it, and I can't add to it, I would happily switch out. And for the third set of months, if I had to look, I know I've done a lot of research on like Travelers, but I don't want an Aflac, but I don't want to really commit to an insurance company. But honestly, I'd put Google back in the portfolio. That's what I'd switch. I'd put the money in T. Rowe Price into Visa, and then whatever I had before in Google, like 5 shares, I'd just transfer that money out, put it into Google. So that'd be my long term if something happened with T. Rowe Price. And then, guys, I just want to buy a share of Berkshire every year for Christmas. So easy there. So overall, guys, we're sitting at near 57K, which is crazy. But I'm very happy with the holdings. I've just been getting a lot of questions about realty income because people keep making, like I said, there's been a lot of videos on it. So I'm not going to make any changes in the portfolio. I plan on adding, not subtracting. But if there's an economic change within a business or a dividend has a massive cut, something like that, there are issues that could happen, and it's very important as an investor to be open-minded and be prepared for when those changes happen. There was a Berkshire meeting where Buffett shows the top 100 companies or top 10 companies in the world by profits like 50 years ago, and they were names like ExxonMobil, IBM, Chevron, like bigger companies, and then he showed a list of now, and it's companies like Microsoft, Apple, Facebook, and none of the original companies were on there. So it's like, yeah, over time, companies change. Different things get invented. Companies find different ways to maximize profits. Every industry has change in it, and the real goal for me is to try to find companies that I don't think will change in the next decade. Do I think real estate's still going to be there? Yeah. People are still going to smoke. They might smoke less, but yes. Do I think that people are going to drink Coca-Cola in a decade? I think so. Apple, yeah, I think people are pretty attached to their iPhones right now. I don't think that's going to change unless there's a massive switch within the smartphone market. AbbVie, people need their drugs. Visa, they process millions and millions of payments a day, and they have been for the last 30, 40 years. I'm not worried about it. T. Rowe Price, are people going to need to invest for their retirement? Yeah, they don't need to choose T. Rowe for it, but I do think that they have a slight competitive advantage in that field. So out of all of them, I'd say economically, the worst company is Altria, and the one that I'd be the closest, the one that I think I would have to switch out earliest would probably be Altria. But even now, I'm comfortable owning those. So there's always going to be issues in a business. There's always going to be changes. But for the medium to long term, I'm not super worried about it. We'll deal with the hiccups with Realty Income or Altria or whatever comes up. I'm not super worried about it. And keep in mind, guys, that's partly why I want to have the big three in Coca-Cola, Apple, Visa, because I don't think Coca-Cola is going anywhere. Even though everybody dogs on me on social media and stuff like that for owning it, you can't deny I don't think it's going to go anywhere. That's really what I want, is that stable cash flow and dividend. Apple, I don't think is going to go anywhere. I think the ecosystem is very strong, and people are addicted to their phones. And then Visa, same thing. I think people are going to swipe regardless. So even if I don't own NVIDIA or Tesla or something like that are like these high growth companies that are showing all these gains, I don't see that as a loss, simply because I don't know where they're going to go, right? I can't predict where those are going to end up. And yeah, while I might miss out on thousands of % returns, I don't see that as a loss because I don't understand them. I would much rather own something I understand and I can calculate why they go up versus something that just shoots up and I'm like, oh yeah, I'm a great investor because I made 1,000% on something everybody owns and that everybody knows is going up. Much rather find diamonds in the rough. But maybe that's why I differ. Maybe that's why I'm not going to hit 100K faster, because I don't want to put money in those companies. But I guess that's part of why you guys watch, right? I have my strategy, and it'll grow how fast it grows. I'm not going to try to force it to bump up higher. I'm just going to keep collecting dividends, put it where it makes sense, and put that cash flow where it makes sense and where it can really make a difference. And we'll get there in time. So with that being said, guys, thank you so much for watching. Remember to hit the subscribe button on my channel, That Dividend Guy. And I'll see you guys tomorrow, Friday, with another Robinhood portfolio update. Take care, guys.